Happy Monday, everybody. I hope you had a great weekend. Today is May 15, 2023, and this is your Monday market update, direct from the financial capital of the world, New York City. Last week was full of news and full of commentary, but as far as things go, not much movement in the markets. At the Fed, in the Congress, at the White House, across the world. But not to disappoint, let's review last week's market action and let's preview what this week will bring. The week got off to a whimper of a start as the news wires were quiet over the weekend. Monday saw markets open quietly, and the only news was some positive headlines on the potential extension of the debt ceiling. Fed head Goolsbee stopped any forward motion with talk about credit squeeze and possible near-term recession. I've mentioned the fact that we've been rolling out surveys and indices that have been covered in dust, and Monday was no different. The survey of senior loan officers has not been quoted in the news since maybe 2009 during the great financial crisis. But here it is again. It did indicate tighter credit and weaker business demand, but that's all not anything new in real news. Markets did pull back near the close and end just off session highs. Very little movement. The Dow was down less than 0.25%, the S&P and the NASDAQ up less than 0.25%. By the way, that puts the NASDAQ into a new bull market, up 20% from the December lows. Does it feel like that? We've spoken about all of the cash on the sidelines, $5 trillion and counting in money markets and such. We don't know where that's going to go and when, but we'll be interested to see where that goes, and the $160 billion in cash the six biggest U.S. and European oil companies are sitting on. The money's going to go into motion somewhere. Which way and when, that's the question. In case you wonder how much power Apple has, by the way, in the HBO show Succession, the latest report I saw said that they do not let the bad guys in the show carry an iPhone. So if you want to know who's good and who's bad, look for the guys carrying the Android. Stocks gapped lower on Tuesday, and the Chinese import numbers were well below estimates. Again, really, Chinese import numbers caused us to gap lower. You can tell that we're starving for data. The market continued to grind sideways as news from the debt ceiling was sparse. Fed heads Williams was back on the tape, let go with all kind of tape bombs. Expects unemployment to rise, modest growth in the economy, Fed not done raising rates, and push back on rate cuts. On the positive side, peak wage inflation. Add that to the report that McCarthy planned to reject a short-term debt relief offer, and no news from the big shot meeting at the White House on that topic, and the markets revisited the session lows. Market ended near the lows of the day. Not much to show, but Dow was down less than 0.25%, the S&P was down about 0.5%, and the NASDAQ was flat. No, really, it was actually flat. Wednesday had markets gap higher this time. What was the cause? So let's see. The CPI was out and was pretty much in line with expectations. Super core inflation rose at the slowest rate since July 2020. Pullback in the markets came on the back of debt ceiling tape bomb that came from McCarthy as he talked tough about keeping the pressure on the president. Late in the day, as things were grinding lower, Google rolled out more news on the flavor of the month, yes, artificial intelligence, and that pushed stocks higher. And in case you've missed it, Google represents nearly 2% of the S&P, so that brought things higher. Now, the Dow was down less than 0.25% again. The S&P was up about 0.5%. The NASDAQ was up a bit over 1%. Stocks opened slightly lower on Thursday and then quickly went for sale. Jobless claims jumped, PPI was in line, and Fed heads were too much for the market. Regional banks were back in the spotlight, and the House of Mouse rolled over after earnings and took the Dow down negative with it. The Bank of England added its most recent rate hike and added hawkish projections. Fed head Bowman spoke in Germany, nothing new, inflation high, labor markets tight, more tightening will likely be appropriate. The loudest voice in the room is still Janet Yellen, warning about debt ceiling. The Dow was down about 2/3 of 1%, the S&P was down 0.25%, the NASDAQ eked out a gain just under 0.25%. Friday brought the end to another week with a lot of news and nothing to move things. Eco data for the day was the University of Michigan sentiment survey, and that fell to 6-month lows. Maybe those that were surveyed fell asleep as this market has had a lack of movement. 5-year inflation outlook was also at the highest since June of 2008. Debt ceiling meetings have been postponed. Some read that as good, some read that as bad. The markets are worried about the economy, along with all the other things to worry about. Overall, the markets were down on the week. The Dow was down a bit over 1%. The S&P was down about 1/3%. The NASDAQ bucked the trend and was up about 0.5% for the week. For Friday, the Dow was down just a hair, really, 8.9 points. S&P was down 0.16%, and the NASDAQ was down about 1/3%. This coming week brings a whole new level of Fed head speak. Monday alone, Bostic, Goolsbee, Kashkari, and Cook. No time for eco data on Monday. Tuesday will bring about Mester, Barr, Williams, Goolsbee, Logan, and Bostic. Eco data will be important. Retail sales. This, of course, is a prime component. It's hard to do the dollar-to-dollar comparisons as they're not adjusted for inflation. Just remember that if you sell the same amount of chicken this week and prices are 10% higher, the retail sales numbers will be 10% higher. So under the hood is going to be a good place to look at this data. Wednesday's pretty slow. No Fed heads and only housing data. Thursday will bring jobless numbers and the labor market back into the limelight, but the Fed heads will still be on tour. Jefferson, Barr, and Logan. Friday brings Bowman, Williams, and even Powell gets into the act. As things go, not much on the eco front this week. What will move markets this week, aside from the more Fed speak than anyone could ever want, the eyes will be on the retail, as I mentioned. We'll get earnings from the big ones, Walmart, Target, Home Depot. Before we think the ride's done, remember we have 4 more inflation reports before the next Fed meeting, which is June 13. 1 more CPI, 1 more PPI, 1 more PCE, and 1 more non-farm payrolls. That's a lot of inflation data to bring in. That's just the big ones. There is a lot to keep an eye on. That's what I'll be doing. Remember, in today's topsy-turvy world where what's bad is good and what's good is bad, we have sentiment as bad as we've seen it in a while. We have $5 trillion plus in cash on the side. We have earnings estimates coming down. Expectations are low. That could lead to relief at some point that things are not as bad as they have feared. On the other side, there are a lot of unknowns, especially the debt ceiling, the geopolitics, all over, and the coming recession that we hear about. Add into that the debate of soft landing, hard landing, and we have the makings of an undecided market. That's why we watch it, and more importantly, this is why we remember that we are long-term investors and we need to position ourselves for what may be coming. This recent move off the lows into 2023 is a good time to reevaluate that asset allocation and even the asset location. That's what we talk about on Fridays, so please come back. The website has both Monday market update and the Friday planning videos right on the front page. Please visit that for the update. For now, have a great week, and we'll see you back here soon.